All right, this is Ken Long from Tortoise Capital Management with a review of the weekend trading reports for April 19th, 2014. The Easter edition. Due to the holidays, we'll go through this pretty quick. Let you get back to your families. So we have a market that is in bullish volatile conditions. On an annual basis, using the weekly RSI 14, we're at neutral with a reading of 61 out of 100. On a short-term basis, using the 10-day NDX, we are at 61 out of 100, so the middle range of neutral. Looking at the market mosaic, price relative to the 200-day moving average is red bullish at 6.28%. So what that means is that we're in bullish conditions because we're more than 2% above the 200-day moving average. But the code of red means that that's among the worst 15% of readings in the last 6 months. So this is evidence of an aging bull. 5-day slope of the 50 is white bullish at 0.54. ADX has drifted below 15, and that is a weekly trending market. That's actually an alert to us for swing trading. Anytime it goes below 15, the market has been so choppy that it's ripe for the next swing trend to develop, which can last 2 to 3 weeks. So we will be on our guard for that to happen. ATR percentage remains volatile at 1.14%. The risk index is the 30-period moving average of the VIX divided by the 10. The threshold for risk on versus risk off is 1.0. That reading is at 0.98, so we just drifted into risk off conditions. When we take that score of 0.98 and compare it to the last 5,000 trading days and take the standard deviation and find the Z-score, we get a risk Z. And that risk Z value right now is minus 0.27. And so we're 1/4 standard deviation below the 6-month average. And if we look at this histogram here of the risk Z, you can see the last 90 days of that indicator. The very choppy nature of this market is seen by the small waves here in the risk Z. So this is a sideways channeling kind of a market. It's not really becoming very volatile or getting much less volatile. It's really just the definition of a choppy market. And we are on a slight uptick, but we're so close to the zero line here that we've got to be prepared for a move in volatility in either direction. And the good news is that there's room to go in both directions, whether we're favoring VXX for the volatile market or XIV for the quiet market. The blended monthly rebalancing, you can see the holdings currently in force with the next reevaluation due on or about 1 May. And you can see the current leaders of each of the model portfolios here, the portfolio populations, with ETF 13 featuring Australia, U.S. real estate, and Asia less Japan. ETF 22 and 32 remain pretty defensive with utilities, energy in Australia, and then agriculture, utilities, and energy in those two respectively. Then the next three are populations of the Dow 30, still being dominated by Alcoa, Hewlett-Packard, Caterpillar, Microsoft, and Disney, and then ETF 200 and the ETF Max with the clear winners there. It's interesting to note that XLU, the S&P sector spiders for utilities, are among the top 10 in the ETF 200. That's just evidence of how defensive the market has become. In ETF 2, the theoretical exposure is at 70%, and the model portfolio is at 80% going forward for another week. Just a quick check of the ETF 13 and ETF 32 portfolios. You can get a quick feel for where they are. Only 3 symbols are on sell signal for ETF 13. That's interestingly the U.S. risk on categories of the NASDAQ and Russell small caps. And you can see they're down about 1% or 2% over the last 3 months, whereas the leaders right now, Australia and real estate, are up 10.5 and 7.5 respectively. And then in the ETF 32, again, there's only a handful of symbols that are on sell positions. That's price relative to the 4-month moving average. Core discretion, consumer discretionary XLY, the Russell 2000 again, NASDAQ, and then XLV, the healthcare, which had been the sector leader for the last really 6 to 9 months. In the ETF Max, this is looking at like 1,300 different symbols. Still at the top, we find the coffee, agriculture, commodity blends, natural gas. So it's all the real assets. Indonesia remain up there. India's all over the place in this. And you see a real shift to defensive assets once more. Looking at the market health check, the last 4 days were almost a mirror image of the previous 4 days. So what we have here are the vertical blue lines representing 10, 20, and 30 days worth of look back. The horizontal red lines are support levels that have been resistance levels in the past. Upon market weakness, those then become price targets on the way down. The horizontal purple lines are price targets to the upside, and I've shown the last 2 here simply because the market's been so choppy that I expect it to be hovering around in this area. The green, yellow, red represent my intuitive estimates of, or my intuitive integrations of my bias. If price gets above 188 and into the green, then my bias is going to be to the long side. I'm looking to take all those trades whenever I can. If it gets into the red below 182, I'm looking to be short whenever possible intraday. When we're in the yellow zone like we are right now, I'm really waiting for the daily market direction to tell me which direction I want to go. So I'll wait a little bit longer to get in and then look for breakdowns above or below yesterday's high or low. And you can see by the size of the intraday ranges and the strong signal days that why that would be the case. In this yellow zone, you get these large one-day directional moves, but with little follow-through. We're basically exactly where we were 40 days ago, and yet there has been tradable moves intraday in that 40-day period. The slope of the 30-day regression line is indicated by this thin black line. In the blue circles, you can see where it was either crossing the 0 line or had made some extreme moves. It looks right now that, based on the last 3 or 4 days, that slope has started to roll over and start to improve. It's not quite flat yet, but it's getting that way. So this would be a natural place for it to find support here at 182. And then support another run up to the previous swing high at 190. So I'm cautiously optimistic here. There's room for it to run. We have about 4%, 5% safety between current price and sideways market, which would occur if we get down around 178-ish, 179. We have 3 regression channels marked off. I'm sorry, we have 2 on here right now. The 10-day is in blue, and that's almost flat, and then the 30-day is the black line. And the outer lines in those channels are formed by the maximum excursion during the look-back period. And you can see we're right in the middle of both the 10 and the 30-day channel. Price is right back onto the 30-day Bollinger Band, right at the center line of the river, which is the dark blue shaded area, which is the 30-period Bollinger Band plus or minus 1. The lighter shaded blue area is the river's floodplain, or the Bollinger Band plus or minus 2. You can see that the It's considerably narrower than it was 30 or 40 days ago, but we're right at the midpoint. This is a market that's chopped around and is fairly valued and is basically flat over the last 30 days. This is, if it were to settle down right here, we could get into sideways quiet channel pretty quickly sometime this week. That would not surprise me. And I'm basically ready to play breakouts out of the floodplain, which is where the essentially the yellow zones are. I'm a little bit quicker to get long, back to the long bias, because of the previous trend being up, which is why the green zone doesn't start after the floodplain, but starts basically right after the, if it were to exit the river. You can see that we've had a double bottom here on the Williams %R for being oversold. Now we're back to about the 50-yard line. The jaws of percent price oscillator, which is a great way to examine intermediate term trends. The downward pressure was closed by the price action of the past week, although volume was low. And so that's a market that's back to fair value. So this is perfectly poised to go in either direction. I think we have to say the default location is up, just because of the fact that we're in bull conditions. Looking at ETF2 next. The regional report, we have 7 of the 10 regions on a buy signal, 3 on cash. That puts us at 70-30 in the theoretical model, which is an improvement from 50-50. The S&P with a score of 44 on strength is slightly better than the Euro-Asia index at 42. So the U.S. is still favored over the global right now. Inside the U.S., the strength is in large caps, then mid caps, then tech, then small caps. So it's kind of a modified risk off here. The 2 strongest sectors, remarkably, are kind of Asia less Japan at 46, and I give Australia a lot of credit for that, and India and Indonesia, and then Latin America ILF, which has really stayed the course and still looking good at 45 on the strength rating. The 2 weakest sectors are IWM, the Russell small caps at 40, and then EWJ Japan at 35. Inside the sector spiders, strength is in utilities, followed by basic materials, energy, and the industrials and staples. So it's still pretty much a conservative posture inside the U.S. sectors. Expanding our view to look at the world market model next. Everything U.S. is slightly below average, with the exception of mid-cap value and then the S&P 500 itself at 44. Japan in the red, Asia less Japan above average. However, China's still in the red. A better array of strength in the Asian countries, with most of them being above average, and real strength in India, Philippines, and Indonesia. Latin American emerging markets above average. That's been a while since we've been able to say that. Mexico lagging, but Brazil coming on strong. A basic parity between the U.S. business sectors and global sectors, but utilities, the defensive plays there, and also in energy and materials are leading the way in terms of the global sectors. ETF top 30 mirrors the same things that we were seeing in the blended monthly rebalancing structure. I like to look at the ones that are green on strength and white on consistency, because that is a newly emerging strength. So that would have us looking at natural gas, oil and gas exploration. So you can see it's the energy sectors here. There's utilities, Philippines, industrial commodity ag, the energy alpha dex, crude oil, more commodities. Turkey ought to be of interest, with green on strength and red on consistency. TUR is one that we probably want to go ahead and take a look at. And it's interesting because it's trading almost 600,000 shares a day. So let's take a look at Turkey when we get to the charts of interest. So a changing of the guard in here that you see with the green and then the ones that are white and even yellow and red. We're shifting now to the daily report. No signals on the overreaction or channeling. You can see how volatility is just quietly creeping higher, back at nudging into the volatile sector. We have channeling and overreaction signals for JP Morgan, United Health, and IBM. United Health and IBM also on 551Ws. And then the auto framer gives us 2-to-1 reward to risk auto trades in Euro Asia, Japan, Asia less Japan, coal, gold, and oil. What with the strength in energy lately, the oil auto trade might be of extreme interest. Taking a look at the Dow tactical summary. Handful of dojis. You can see the channeling and overreaction signals. JP Morgan 8-to-1 on the auto framer, Pfizer and United Health at 5 and 4-to-1 respectively. United Health should be of interest, down 3% in the red on Thursday, RSI 2 value of 4, and tests out at 4-to-1 and is an overreaction trade. And then IBM with a 5 on RSI 2 and a 2.6-to-1. Shifting to the ETF tactical summary. We have no pattern trades, but we do have a handful of dojis. Silver has an RSI 2 value of 9 and comes in at 2.5-to-1 and is number 1 on the max pain range compression. The VIX comes in at a score of 9 on RSI 2 and at 3-to-1 on the auto framer. So that should be of interest. Here's the auto framer. Just a quick look for your references. Again, JP Morgan, Pfizer, Cliffs Natural Resources are on our short list. There's the gold and silver trade, and VXX as well. Now, what looks promising here on the market mosaic charts 5 through 8, if we take a look at chart number 7, what we have is the slope of the 30-day regression line. This is looking at the last 200 days. Bottomed out here at about minus 0.1 slope value and is now getting ready to cross its own 10-day moving average. The last time it made that kind of a move, it was a really strong 8% gain off the local low, and so we're postured for that kind of a bounce to the upside. So that's an alert to a potential state change. All right, I want to shift to charts of interest now just to wind this up. All right, what we want to look at here on the S&P, we're looking at a 30-minute chart, so this is really some swing trading. We've had a nice rebound the last 4 days inside this channel. And so now the question really remains, is if we're going to be able to see the market to be able to get above this 187. And there's some resistance here. But if it does, then, you know, an all-time high up here at 190 is within close proximity. The natural rebounding place of 50% retracement back to fair value, if you look at the VWAP, fair value looks like about 184.5, and so that's really the risk level is if it fails. All right, so we're going to take a look at Turkey real quick. And we want to start on a weekly to see what the what that kind of rebound looks like. Definitely a washout kind of a candidate here, as we see this previous support level around 42 held support. And now we're looking at 60, 75. So if we think if that support level is going to hold, even with something as wide as a $10 stop, we would say, can we see 20 above? So 52 plus 20 would get us up to 72. So there's certainly 2 units of reward available. So Turkey ought to be on our interesting list here. This was probably a function of the spillover from the Crimean challenges, which means we want to take a look at Russia too, the RSX swing trade. And even on a weekly basis, Russia still has things going for it. If they can not isolate themselves from the rest of the international community, if they can demonstrate some reason, there's reason to believe in a return to the Bollinger Band mean at 27 from 24. So that's a 3-point move. And so with a risk of 1.5, looking at 27 is not unreasonable. So let's zoom in a little bit on that one. We'll shift down to the swing trade time frame. And you can see why this was such an attractive trade this past week for us. And you can see pattern 7 developing here in RSX. With price down here outside of the plus or minus 3 Bollinger Band. There's your RLCO. Here's your buy point, not later than 2260. And even if you use, 2180, that's an 80-cent stop. And that's already quite a move to the upside. So I think Russia is no place for the timid, and it's still tough for me to hold that one overnight. But the intraday trades have been pretty reasonable. Let's see if we can find one. Actually, there's some charts in the chat room that will show that on an intraday basis and a turbo basis. It's pretty compelling. So I'm going to hold it there. unless there's any charts you guys would like to see, that's where I would propose to call it. Let you get back to enjoying your Easter, and I'll get this process. So last call for any questions or any charts that you'd like to see. If none, doesn't look like it, I'm going to go ahead and call it there and wish you guys a happy Easter and enjoy the rest of your evening. The chart should be, the video should be uploaded in about an hour. So take good care, and we'll see you in the chat room.